All right, hello everybody, and welcome to lesson number 5, the Academy of Financial Trading course. My name is Sean Fitzgerald, and tonight I'm going to be taking you through elementary charting. Right, so now just before we get started, as normal, first things first, quick sound check. Make sure everybody can hear me loud and clear now that we've begun. So if you can just give me a yes, let me know everything's okay and that the sound is coming through. Fantastic, everyone can hear me. And then, as you know as well, as always, first things first we have to do is the risk warning. As we all know, trading carries some risk within it, but what we plan to do here at the course is mitigate that risk. What we're trying to do is make the risk as small as possible so that it doesn't hurt you as badly, but we have to remember it is always there. It is always an element. Okay, so I hope you're all familiar with that. I'm pretty sure you guys are at this stage. This is lesson 5, but just got to make sure that you do all fully understand, obviously, the risks within financial trading. Right, so we're going to talk a bit about technical analysis. It's something that you've looked at a little bit already. It's the study of price action in order to attempt to gauge probabilities. So basically all you're doing is analyzing numbers and behaviors to try predict a little bit with some certainty about how things are going to happen going forward. So previously what you looked at with Tom in the last lesson was Japanese candles. So hopefully you have a bit more of understanding now about how great these little things actually are. How a simple little box with one color and two little lines sticking out of it, how much information it can give you, which is absolutely loads, which is why we love them, which is why we encourage you to get to know them, get to understand them, and that's how we trade, why we trade with them, because they just are that brilliant. Now, what we're going to be doing tonight is covering the topics of support and resistance. And as you'll see with support and resistance, like we saw previously with going long and going short, these are just terms that, people in the trading business like to use. There are other terms for them. And you'll see that they are quite simple to understand once you've had a look at them and understand them easily. And you can use other terms for them, but you'll get to know them quite easily. But we're going to be talking about them, and the terms we're going to be using are support and resistance. We'll also be talking about breakouts. Now, we have looked a little bit at these in the past, and we have discussed them. But tonight, we're going to be going a little bit further, looking where you're going to be spotting them when you do spot them, and how important it is to wait and get a confirmation of these breakouts, which if you don't understand what I'm saying right now, don't worry. We're going to get there. This is a 10 lesson course. As I've said to you before, don't get ahead of yourselves. Just take things one step at a time. It'll all make sense as we slowly link everything together. Then another term is going to be trends. Now, most of you probably understand what the word trend means already. We talk about fashion trends a lot. Something is trending on Twitter. Well, we're going to be looking at financial trending, what it means to us and what we can use it for. Then another thing we'll be looking at is channels. Again, just another technical term for something quite easy to understand once you have had a look at it and had it explained to you. So, support and resistance. What do I mean when I say support and resistance? Can anybody out there, have you heard of support and resistance before? And if so, have you heard of other terms for them? Is this something else that you would call? Exactly, Thomas Warnock, you got it straight away. Floors and ceilings. That's sometimes what people refer to them as well. It's basically a price area that tends to act as a barrier. A kind of a barrier, okay? So when we're in a room, where I'm sitting right now, there are two barriers above and below me. There's a ceiling above me. Now, I can't quite jump that high, but let's pretend that I'm Michael Jordan and I wanted to jump up. If I try to punch through that, I'm not going to get through the ceiling. And as I walk around, I'm not going through the floor. So there are barriers to stop me going up or down. Now, the bottom end zone, which market has difficulty breaking through, is known as support. Right, so the support is the floor, it's the bottom. A way to remember this is, if you can't remember support and resistance, when you're in a room, what is supporting your weight? Well, it's the floor, so support is the weight. All right, and then obviously resistance is just the opposite. So the top end zone that the market has difficulty breaching through is known as resistance. Now, what's important to remember that these are zones. There's not just a strict line. okay? Now, the way we're going to be looking at it, we'll be drawing some lines onto charts. You'll see other traders sometimes just use a straight line. But it is important to note, it is not strictly a straight line. It's a zone. It's an area. So we have the support zone and the resistance zone. Now, don't worry, as we go through the lesson, this will make far more sense because, as always, we're going to be using lots of examples, pointing it out, and it will click with you, if not straight away, after a little bit. Now, you want to view them as temporary floors and ceilings with uneven surfaces. This uneven surface is basically to give you an understanding of it being a zone or an area. So, a floor in the market. Now, it usually has to do with just supply and demand, or always has to do with supply and demand, and it's low levels where participants deemed that the price would not be justified in passing below that level at that time. Now, what are the reasons for this? Well, it can be because of any number of reasons. It can be just assumed fair value. It could just be people saying, well, it shouldn't go below that because that's not a fair number for it to be valued at below. It can be psychological issues, too much pain to go below that. People would feel being ripped off, so they're just not willing to sell below that. Or there could be a third-party intervention, like a bank or a government, getting involved and maintaining something for a certain reason, which I'm pretty sure we've all heard of in the past, and it's going to be an example of something we're looking at tonight. So, to begin with, let's look at this example, all right? So this is the Euro-Swiss franc. Now, we're all quite used to our candle charts. Here we have a daily candle chart, and it's with the euro to Swiss franc, and it's starting back in December 2011. Okay, now it starts off with the euro weakening and the Swiss franc strengthening. Now, this is actually bad for the Swiss. Why would it be bad for the Swiss that the euro is weakening and that the Swiss franc is strengthening? Can anybody tell me why that is a bad thing? Exactly, trading, purchasing power, tourism. Where is Switzerland? Well, Switzerland is bang on in the middle of the EU. They are surrounded by nothing but EU countries. So all of the people that they're trading with, that they're buying with, that they're doing business with, well, they're all Euro countries. So they don't want this huge disparity. So what we see is that down here, in this area, we see what appears to be a little bit of a floor. As it goes along, there are a few spikes, but it doesn't seem to be going below 1.20. Right? So why did this happen? Can anybody remember back in 2012, in April 2012, why did 1.20 become the floor? Okay, well, we were talking about the different reasons it could happen. One of the reasons here, and the reason that it did happen, was government intervention or Swiss banks intervening. And they started buying at 120 because they just did not want it to go below that. Right? So all these Swiss banks get involved. They go along and they maintain 1.20 as the floor as it goes along. Now, would they be winning or losing if the market suddenly goes to 1.19? So if they're maintaining this price of 120, what would happen if it went to 119? Exactly. Okay, they'd be losing because they're buying at 119. So they're buying. Now, their main aim at buying is to maintain this price, to maintain this floor. But by buying, they're going long. They want to do well if it goes up. So if it drops down to 119, they start to do badly. Now, why are we mentioning this? Because we can see a clear floor in the market. The Swiss are protecting their economy. Now, there are going to be big jumps as well. And, big jumps are basically where people panic and people may lose or they may win big. Now, later we're going to look at what happens when these support levels fail. But right now, this is just a good example of seeing intervention by a third party to basically protect their government's, their country's own economy, which makes a lot of sense when you think about it in terms of protecting their economy. But as we can see, as it went forward, we had big jumps, we had big drops, and, at 11th June 2013, we can see that it was 1.22. So not a huge change for 1.20, but you can see that there was a lot of up and down in between. So we can see how it went. It went up a lot, which is going long. It went down a lot, which is where you were going short. It's 120 to 125 range, which isn't huge, but we can still see in terms of pips for us. As traders, those are big swings and changes. But what we're looking at here, remember, is just why did it not go through the floor of 120? And that is because of government intervention. Now, remember, it's not how you feel about a market. It's what people in the market do. Okay? So the key point is the volume of trades at these levels is what makes the price hold strong. So a secondary issue to remember is if a breach were to occur, and when I say breach, I mean sudden change above the ceiling or below the floor, which is what we'll be looking at a while. What is likely to be on the far side of that price if many traders traded oppositely to the potential breach stops. So it's not how much you think something might happen, it is about how much capital is actually committed to the market. Okay? So now this might seem like a bit of an abstract statement right now, but don't worry, as we go on, it'll start to make more sense, okay? We are looking for when people do something wrong. Market maker trading, we win when other people make mistakes. So traders must decide to range trade or breakout trade or both. So what we're going to be looking at tonight a little bit, like I said at the start of the lesson, was breakouts were something we're going to be looking at. So obviously breakout trading is going to be our example. So let's have a look here at a floor break. Okay, so starting on 29th of July 2014, we're looking again at the euro versus Swiss dollar. All right, so where is our floor? Can we all see the floor quite clearly? Well, there is the range, right? We were discussing that the floor is 1.20. So we know that this is, well, we know because we just said it, that this is because the Swiss banks are maintaining this. They're buying at 120, they're not letting it go below. So, what happened on the 13th of January 2015? Now, some people will remember and they'll know what happened, and some people can make a very educated guess based on what we're talking about here. Right? So something happened on the 13th of January 2015. Thank you very much, Michael. You got it straight away. Yes. On 13th of January last year, the Swiss National Bank announced that they are no longer going to support the euro. Now, why did they decide they were not going to support the euro anymore? Okay, we can look at this chart and we can think about why. Anybody give me an example there, or what do you think of the situation? Okay, well, it could have been too expensive to maintain. They could have decided as economists that they wanted to step aside and let the market dictate. I'm going to be honest, I don't know the exact answer, but what's important is I don't want to know the exact answer. I don't need to know why this happened. We just need to know that it did happen. On 30th of January, we see this massive drop. The floor goes way more down. There was a range from 120 to 119. The floor was quite obvious. And then we had this sudden drop down on the 13th of January. So we can see the timeline perfectly. We can see this gigantic drop. And then basically there's an establishment of a new floor. So they took away the floor. Now, again, simple metaphor. You're standing in a room. What happens when someone takes away the floor? Well, other than you falling, there's extreme panic. So we could see that there was extreme panic and it dropped straight down to 1.04 roughly. Well, that's where it was after a while. That's where it balanced out in March. But we can see the massive drop, and that's what's important to note. Now, again, let's look at another floor here. All right. So we can see that this is the Euro US daily in the top left corner. And we can see here roughly from the 27th of November 2013 to the 19th of June 2014. Can everybody see the floor that we're establishing? All right. And most importantly is that we're looking at two lines. Okay. So there are two lines, and imagine it's kind of a tennis ball bouncing along. Okay. So what would you do here? I want you to think about. What would you do here, right? We have a clear established floor, which is what we like to call the no-fly zone. Again, this is just a term, this is just a nickname. It's to show that the floor has a little bit of a range. All right, we can see that the range seems to go from 134.6 to maybe 135.2 or so. But it's a little bit of a range, but we can see it quite clearly. Okay, now at the start of this range, there's a bounce. We can see it here. There's just a little bounce on the 27th of November. It goes up. And then we can see again on the 19th of December, there's another little bounce. Now, where's the third bounce? Can people give me the rough date? Where's the third bounce? Just so you guys are seeing the pattern. All right, we can see it here, exactly 14th of February. There's a few different people guessing, but, I want you to think about the bounce. It's hitting the floor, it's going back up. We can see it. All right, and then again, a bounce on the 5th of February. Right, so I want you to imagine that you are looking at this as a trader and you're seeing these bounces and you're seeing this floor and you've seen these 4 bounces. Okay, so bounce 1, bounce 2, bounce 3, bounce 4, and you have been correct about the floor every time. Now, someone notices the floor, they make a trade. It goes well. Okay, well then it hits the floor again, they make another trade. They're buying. Not only are they buying, it's also building their confidence. Then the third time, they make another trade. It goes as they predicted again. They've bought, they've done well, their confidence is boosted. The fourth bounce happens. They make a buy, it goes exactly as predicted. They're doing well. Now, what do you think happens when this 5th bounce comes? So a trader has seen 4 bounces. He's bought 4 times. He's been very happy. Now he sees a 5th bounce. How confident do you think he is? How much money do you think he's putting in there? All right. Is he going to pump in a lot of his capital or is he going to pump in a low amount of his capital? All right, yes, in general, yes, you're going to be pretty confident. If you get something right 4 times in a row, the 5th time, you're going to be pretty confident in yourself. You're going to put a lot of capital in there. Now, what happens if it goes through the floor? If we said to ourselves, we're going to mark here. We're going to put in a short sell order at 134. Because if it goes through this floor and if it hits 134, it's gone through the floor. And we were to put a short sell order here. So, other traders are looking at these bounces. We're looking at the floor as well, but we're looking at it from a different point of view. We're looking at it, well, what if it goes through that floor? What if it hits 134? Right? So below the 1.35 support line, remember this is the floor, so it's the support, we can envisage longs exiting. We can envisage them selling. Because if they see it go through that, what are they going to do? Well, they're probably going to panic. Now, let's see what did happen, all right? So down here, you can see that the date at the end of this range is the 10th of July, 2014. So let's zoom out a bit. Let's have a look at, if you move up to July 2014, it's the Euro USD weekly. Now, we can see here, again, July, roughly the same time period. It has gone through that floor. Now, what happened when it went through that floor? So we put in our our selling order at 134. We decided to go short, and it went through the floor. It hit that 134. What happened after that? Okay, exactly. Nathan said it beautifully. Tom Petty's free falling. Exactly. Panic. The market just went into downwards. Just went down and down and down. We can see over the time it kept going down. It didn't stop. So all the longs are losing below 1.35. So when retail traders get it wrong, they get it very wrong. Now, are we seeing a pattern reappear? Are we seeing a new floor appear? Are we seeing a new ceiling appear? Are we seeing new ones? Yes, we are. Exactly. We can see that there is a new no-fly zone floor, a support at roughly the 1.05 mark. Now, it hasn't been long enough for us to establish it yet, but we can see that it's gradually building up. Right? So, let's look at the crude oil market. Just again, it doesn't matter what we're trading. Remember, it doesn't matter if this is currency, if this is stock. if this is an index, whatever we're just looking for the same thing over and over again. So can someone tell me, where can we see a support line here? Where are we seeing a support line kick in roughly? Where are we seeing it begin? Now I want you to think in terms of date or in terms of price. Give me either. All right, I would say roughly around the April-May mark, around the 57.2 mark. As a lot of people pointed out, yeah, we're seeing it just roughly around there. All right, that is our support. We can see it. We can see this pattern emerging. There's a bit of a support. So where is this starting? It's around the just late April. We're seeing it come in. Now, we can see again, there's this floor. What's going to happen when this floor gives way? All right, I want you to remember the time range. We're looking here from April to June 2015. What happens when this floor gives way? Exactly. We're all understanding it straight away. Yes, when this floor gives way, so here's our floor. Just we've zoomed out a bit. I want everyone to remember we're zooming out. We're looking at the same time period. We're looking at April roughly till July up there. But then we see it comes through the floor. And what happens? Well, it goes down. It's tumbling down. We can see the panic. But what do we see after the panic? What are we seeing after the panic has gone by? Exactly, Douglas. We're seeing a new floor. Jennifer, you got it as well. A new floor. We're seeing a new floor come in. So this is what we're looking for. We're looking for a floor or a ceiling being established, and then we're looking for a breakout. We're looking for something going through it. That no-fly zone. All right. So again, we're looking at crude oil. We're looking at a rough time range. There's a start of a second floor. Now, why did it bounce here for a few days? All right, so after the crash, suddenly there's a new floor. We can see it's quite short. It's quite short at the start. We're just looking at July. I just want you to focus at the start of July, 3rd of July till the 22nd July. There was a little floor there. Can anybody tell me why is the floor here at around... Now, I'm not going to say around what mark, because that's a hint to the answer. It's around a certain mark. And why is it at that certain mark? Okay, some people saying confusion because there's a resistance. Somebody got involved, APEC. But Christopher Stratton has hit the nail on the head. Sometimes it's just psychological. The new floor is $50. Because $50 is a nice round number, and people in their head are thinking, well, it's not going to go below $50 a barrel. You know, everybody knows oil doesn't go below $50 a barrel. So at 50, I'm going to put in a buy order. So it comes down to 50, it hits it, and people put in buy orders. So it stays above 50. But, you know, is a financial market going to be dictated by people thinking that something should be a certain price? Well, for a little while it can be, as we can see here. But it doesn't stay that way for long. What happens? It only lasts a few days, and down it goes. Now, what do we see after it goes down? Again, we see a new floor kick in. Now, we can remember there is a little bit of a range. You have to remember the range. So we're seeing a new floor. Now, what does this floor and the old floor give us? Well, yes, exactly, Richard. You're exactly right. You're a little bit ahead of me. I don't see a floor. I see a ceiling. Exactly. We're seeing a new ceiling, right? So this is Bob. Bob lives on the second floor. Bob loves it up there. He's got a great carpet on his floor, and he really likes it. It supports him. It's supporting his weight. It supports his furniture. It supports his PC, where he attends his Academy of Financial Trading lectures, and that's why he's looking so happy. Now, down on the first floor, we have Greg. Greg is also being supported on his floor, but when he looks up, he sees a ceiling. So remember, a floor can be a ceiling to others. What was support on the way down is resistance on the way up, right? So we can see it there quite clearly from each person's point of view. We can see that it was a floor for a while, but now it's a ceiling over here. All right, is that clear to everybody? You can see exactly how the floor has been broken through, and then it's a ceiling. All right? Exactly. It all makes a lot of sense. Just remember, if you're at a party and you were jumping up and down loads and you were just going too crazy and you fell through the floor and you were lucky enough to land in a party downstairs, well, when you're looking up, you'd now be looking at a new ceiling. What was your floor previously? Now, let's have a look here. Again, we're looking at oil. Now, does anybody know roughly where the price of oil is since this screen grab? Now, this is not something you have to know. Well, Andrew does know it, Tony does know it, Stuart knows it, well, a lot of people know it. Yeah, we're down around the $30 mark now. But, this screen grab shows us an earlier floor of around 39. Okay, and where is it showing us a ceiling? Can somebody give me a rough idea where are we seeing our ceiling right now? Just not right now, in this slide. Okay, no, Tony, it's a little higher than that. Fiona, I would say a little higher as well. I wouldn't say our ceiling is at 41. I'd say our ceiling's up here. I'd say it's up at around 49. Down at 41, we can see that it's gone above and below that loads. Where our ceiling is for this range, I would say it's roughly at the 49, okay? So just, look at it, sit back a bit, have a look at it from far away, and what you're hoping to see is, an area where it just does not want to go above and an area where it just does not want to go below. Those are your floors and your ceilings. Right, still dealing with oil. Again, one little thing we always have to take into account is just human nature, right? And retail traders are usually more optimistic than pessimistic. They believe more in rises than falls. But when a breach happens, it's moved on eagerly. Be it panic or be it enthusiasm when it's going up. So, again, what are we looking at? We're looking at a floor. The stop losses are selling off once it's broken through that floor. So we can see the panic, we can see it going down. Right? Again, I'm just going to give a little highlight to the floor where it is. But, you guys should be well able to spot these breakout points, right? So we can see the range of the floor. And that little red candle, when I say little, because it's big in comparison there, when that big red candle broke through the floor, when it went all the way through the no-fly zone, went through the bottom, out the bottom, what did we see? Well, we saw panic. We saw the price go down. So we saw all the stop losses kicking in. We saw people selling off. We had a new floor here for a while. It broke through that floor. It kept going. We had another floor here for a small while. It broke through that floor. It kept going. So remember, it can keep going, but if you take small ranges, we can see new floors, or you can take a long range and you can see a wider floor or a ceiling. It just depends on the range you take into account what you're looking for. Now, obviously, we've been talking about floors. There's a lot. But on the other hand, there is, of course, the opposite. There is resistance. There is the ceiling in the market. So we've seen all the floors. Obviously, now we're going to look at the ceilings a little bit. Now, remember, we don't care whether it goes through the ceiling or whether it goes through the floor. Why do we not care whether it goes through the ceiling or goes through the floor? Can anybody tell me? It's not just because we're super cool and we're wearing leather jackets and we don't care. As Andrew Smith said, we're here to make money. That's the only reason we're here. I don't want to go around telling people I'm a cool trader that only trades oil and gold and silver and platinum because those are cool stock. I'm in tech stock like Apple and Microsoft. I'll trade anything. I'll trade potatoes. I'll trade ice cream. I'll trade Barbie dolls, whatever can make us money. That's what we're looking at. And at the same time, we don't care about stock going up or whether it's going down. We just care about knowing when to go long and when to go short because we're just here to make money. We can save the world in our free time at the weekends cleaning up beaches. Right now, let's just make bigger checks. So highs where traders believe that the price should not pass above that level is the resistance. It's the ceiling. And again, perhaps that could be because of assumed fair value, psychological values, and or intervention when some third parties are actively participating to participate the breach. Now, so, if I was to ask you, why is it happening? Is it because of psychological values? Let's go with the crude oil example. If I was to ask you right now, why is it happening? Is it because of fair value? Is it because of psychological issues? Is it because of supply and demand? As a trader, what would you tell me? What would you tell me right now after we've just gone, Garrett, thank you so much. Garrett just said it, I don't care. We don't care why it's happening. That's not what we're looking for. Technical traders should not worry about why a market is or isn't doing X. They should focus on what the market is telling them to do. So when you tell people you're a trader and they say, oh, that's very interesting. Can you tell me why Apple stock is, going up at the moment? Is it because they've announced their new iPhone, or is it because Samsung is doing badly? You will just turn around to them and you say, I don't care. I don't care whether Apple stock is going up or down. I'm looking for patterns. I'm looking to make money. I'm not interested in the gossip of, Steve Jobs and Apple. I'm interested in can I make money? So, again, try to put your orders preventing a top-end breach. Also try to imagine stops on the far side of the resistance border, because that's what we're looking for. That's what we're interested in. That's what we care about. Just here to make money. I hope you all remember Michael Douglas from Wall Street, as I'm pretty sure it inspired some of you to come here, but that's why we're here. Now, again, we can quite clearly see floors and ceilings here. Now, this is in the DAX index. Now, can anyone notice something about the ceiling? Something noteworthy, something remarkable at the ceiling we're looking at. Now, I'm not gonna point out where the ceiling Okay, Joe, thank you very much. You pointed out it's a nice round number. Lots of you are getting it. Maddie says, Evo, Jennifer, you're all starting to spot it, right? It's 10,000. Why is it 10,000? Well, it could just be psychological. That's a nice round number. People are hitting 10,000 like, oh, well, I've made my money. I've hit 10,000. This is where I sell. So it goes down a bit. This is a little bit of an emotional, psychological level here. So this is December 2014. We can see a bit of a floor as well. Now, remember, a floor or a ceiling doesn't have to be exactly horizontal. You can see a floor just being a steep rising floor, just like in real life, the side of a mountain. It's still a solid floor, it just happens to be rising. So can people see the floor here? Even though it's not horizontal and easy to see in that terms, it is rising, but it is still a floor. If we draw these two red lines, we see that it's bouncing in our no-fly zone. It's bouncing, it's bouncing, it's bouncing. So this is the DAX in December 2014. What do people think happened after this? Where did we go after this happened? Right? We can see this ceiling bouncing everything constantly off this floor. We can see the floor slowly driving up. So what happened after this? Well, afterwards, you can see December 2014 again. We can see a sharp rise. So we can see our ceiling. We can see the bounces that we looked at earlier. We can see our floor. Again, it bounced off that floor as that floor rose. And then there was a breakout. It broke out at the top of the ceiling, and what did it do? Well, it rose very quickly. It went sharply in that direction. Once it breaks through the expected range, we see a large jump in that direction. Now, can we see a new emotional barrier coming? Do we see something else happening? Well, we see, the 11,102 mark. There's maybe a little bit of a bounce there, but it continues to go up a bit. Then we see a 12. There's a little bit of a ceiling there. But let's have a look at it, another example, where here we're looking at the Australian dollar versus US dollar. Now, again on the left, seeing a simple range with an upside breach and another range here in the middle where we had a downward breach. All right, remember that middle red line is a floor at the start, and it's a ceiling afterwards. It's our support at the start, then it becomes our resistance. So then we see another range down here to the right, which has a new support and a new resistance. But the same thing happens with mistakes being made. So what I'm going to do is I'm going to zoom into this area down here where we see, again, a floor and a ceiling. All right, so we see these mini breakouts. But again, it always comes back within the range. So what I'm going to do is this area down here, we're going to zoom in on this and have a little bit of a closer look. Right, so that's still the same chart. We've just gone in a little bit closer and we're trying to find a floor and a ceiling. Right, so can we see our range here? If I was to ask you the floor here, does the floor seem to be lowering? Does it seem to be rising? Or does it seem to be staying horizontal? All right, well, what I would say here is we can see a floor kind of going down slowly. So our range is going down a little bit, right? So a retail trader doesn't know what to do when there is a little breach. But what we're looking for is we're looking for these ranges. So that's what we're going to be focusing. We're focusing on these breaches. Now, there's sometimes will be a little breach and sometimes it'll be a large breach. We can't tell what's going to happen, but we can plan for either eventuality, which is what we're going to be looking for. So let's start off looking up here, okay? We're looking at our normal range. We have our floor, our support, and we have our ceiling. We have our resistance. What do we have afterwards? Well, we have a massive drop. That's what we have. There's range has a relatively straight floor, and then we can see the sloping resistance, right? So why is this important, right? Even while this drop is happening, what's important to note is during the drop, there is still a ceiling and there's still a floor. I've been able to draw a red line, I've been able to draw a green line, and we can see that it's bounced up and down. Now, it's an incredibly steep floor and an incredibly steep ceiling, but Dragomir puts it in a nice way. It's a stable drop, okay? It's a controlled descent, a stable drop, you could call it that if you wanted to. But we can still see a floor and we can still see a ceiling. So then at the bottom, I think it's quite obvious. We can see our new floor and we can see our new ceiling. We can see again that they're sloping. Now, if I was to say to you at this point, just after the 7th of January, at the end of this, where we have a sloping downward ceiling, we have a horizontal floor. And I was to say to you, well, what do you want to do here? Do you want to go long? Do you want to go short? Or do you want to do something else? All right, I'm getting lots of mixtures result. Oh, Tony, you're on the ball. You got the right one. A couple of people starting to click in. Piers, you have it as well. Yeah, I wouldn't go long or I wouldn't go short. I'd wait. We're going to wait for confirmation. Let's see what happens. We're not sure yet what's happening here. So let's just wait. We don't have to be impatient. If we're impatient and we rush in, that's how we make rash decisions. It's how we lose money. So let's have a little bit of patience. We'll wait for a little bit of confirmation and then we'll make our decision. We'll make our smart decision. We'll make our good decision. And when we make smart decisions and we make good decisions, what else are we making? That's right, money. And that's exactly what we want to be making. Hey, that's what we're looking for. Right. So what I'm going to do is we're going to go down here and zoom in this area, right? So this is coffee. It's a daily chart. And as you can see, it goes from Jan 2011 to April 2012. But what we're going to do is we're going to zoom in on this range down here. Let's get a closer look. So all the Blade Runner fans, this is where you say enhance. And we zoom in. So what we want to do is we want to wait for a breach. But also we want to be sure. So we have a protective get out point. So again, we can see our floor. We can see our ceiling. We can see that it's bouncing through there. Now, if it breaches, that's what we're looking for, all right? We're looking for a possible confirmed breach. Or it's just going to bounce back inside the range. So if I was to say to you right here, where it is right now, it's about to bounce off the floor. We're down at 174.95. It's about to bounce off the floor. Do we want to go long here or do we want to go short? Okay. Some people still want to go long and some people still want to go short. We don't know yet. Let's be more patient. Let's wait. We're waiting for a confirmed breach. Can anybody here see a confirmed breach within this range? Can we see a breach here? Can anybody see a breach? Okay, good. Nobody can see a breach, so we all understand what a breach is. And what we're looking for is we're looking for a breach, right? So there's a possible confirmed breach and there's a possible failure at resistance. We don't know yet. So we're not going to go long and we're not going to go short because if we don't know, we're not going to put our money in yet. We're not going to make that decision. We're not going to put in any orders. So when the breach occurs, that's when we put in an order. Now, we haven't seen it breach yet, so we're not going to put in an order. But if it were to breach, what we would do is we would put in a buying order down there. So we can see that there's a possible breach coming. It could possibly go down. At the same time, it could bounce off the support and come back up. So what we might do is we would put in a short order a little bit below 174. So we're seeing 174 as our support. Where would we put in our short order? Sorry, we're not going to put in a buying order because we think it could go below, it could breach downwards, it could go short, and then we would put in a short order at probably a little bit below 173. Maybe 173.0, depending on what our no-fly zone looks like. So we have to look at our no-fly zone, and if it comes below that. So if it does come below that, we have our short order in there, and we'll pick it up because we think a breach is happening. If it doesn't come below that, our short order never gets processed, and we haven't lost anything. So what we're doing is we're making sure, because there's also the possible bounce back up. There's the possible that it just stays in the range. So that's what we're looking for. Now, remember, momentum is a thing, right? Never preempt a bounce or a breakout. That is always what we're looking for here, okay? Remember, there are plenty of traders out there who try to predict the market, how it's going. Don't try to look into your crystal ball and decide whether a bounce or a breakout is happening, right? Some people saying, what is a preempt? It means trying to guess beforehand what's going to happen, trying to tell the future, like a fortune teller will preempt your future. So we're not trying to preempt a bounce or a breakout. We're trying to wait for confirmation, right? Price moves through the movement of large orders, called order flow. For you to predict a move opposite to current price action without confirmation is essentially the same thing as thinking you can stand in front of a train and it'll just stop and reverse before it hits you. Now, I know a few of us are willing to take a few long odds, but is that a chance you're willing to take? Are you going to stand in front of a moving train that has momentum? No, don't ever stand in front of a fast moving train, right? Does anybody know Newton's first law of motion? That's right, ladies and gentlemen. It's not just a trading course. We're going to throw some physics knowledge at you for free. Newton's first law of motion is that something will keep going. Something with momentum. And a body in motion will keep going unless acted upon by an outside force. So this train has momentum. These stocks have momentum. These indexes have momentum. They're going to keep going unless something acts upon them. So don't just assume they're going to act for no reason. Wait for confirmation, right? That's why we have it written down here. That's so important. Wait for confirmation. All right. So when talking about support and resistance, remember that they are just floors and ceilings. The floor supports your weight. So that's how you remember. Support is the bottom. Resistance is the top. A break is a breach of those levels. So a breakout is when you go through the floor or you go through the ceiling. Right? Just simply picture an object smashing through a floor or a ceiling. It's breaking that physical barrier. Right? Would you think it's going to keep going or just stop, given the momentum that smashed it through that barrier in the first place? It's going to keep going. Exactly, Andrew. Thank you. These things usually will keep going. So that's what we're looking for. That's what we think is going to happen, all right? So when you have your breakout, you have your new highs or new lows. Markets eventually leave every range at some point because the facts change. Businesses do well, businesses do badly. There are things that impact prices, outside of business. And when these things happen, that's when we see changes. That's when we see a new range. The supply and demand dynamic shifts, Demand can be shortened by things being lost. Things like agriculture, if there's a bad year, if the stocks aren't ahead, supply and demand changes. Market can take a new direction contrary to everyone's desires, hopes and dreams. The market does not just obey your will. So remember though, when looking at these breaks, right? So when looking at breaks, they can either be false or genuine. We saw a couple of them where there was just a little break, but it came straight back inside the range. Right? So that's why we have the no-fly zone. We're looking not just for it to cross a strict line, we're looking for it to be a proper break, a genuine break. So we never know in advance which it is. You can't tell for definite. But, if we could, that would be fantastic, but we can't. So what we're looking for is trends because they generally begin as breaks. So we're looking for the breaks, then we're going to put in our buying order or our short order, and we're going to put in our stop loss or our stop profit because that's what we're looking to do going ahead. We're looking to make smart decisions based on what the market does, not based on our gut feeling. So the longer the range existed, the larger the potential move. In general, if and when a break occurs. Right? So traders attempt to use breaks to catch trends in their infancy. The earlier we catch the move, the more profit we can secure. Obviously, if something rockets up in price, if we put in a buy order earlier, we got it at a lower amount, which means when we exit the trade at the top, we're getting larger profits. Exact same way if something plummets downwards and we put in a going short order early or a selling order early, when it reaches the bottom point and we exit the trade, we've made far more profit. Right, so breaks in entry, right? So traders typically find entry the easy part, right? We looked at all those graphs, we saw all those ranges, we saw those breaks. We know exactly where to get involved. Where do you want to buy or where do you want to go short? Well, when it breaks through my low fly zone. Entry is usually upon or after a close outside of the defined range in favor of the break. So closes help us gauge if the break has a higher degree of confirmation, as simply trading above the level without a close would be testing the area, which is a little bit dangerous, a little bit risky. And what are we trying to do here? Well, we're trying to mitigate the danger and the risk. So let's explore some examples. All right. So here we have the Dow Jones US Top 30, which is the top 30 companies in the US. And here we can see a ceiling, just a little bit of a ceiling, a little bit of a short range, just bouncing there. We can also see our floor. And what we're going to do is zoom in a little bit, have a closer look, and we see a break. We see a break in the downward direction. It goes through the floor. Now, what happens after this break? What do we know about breakouts? What have we been seeing so far? All right, exactly. It's a big break, it plummets, and a new trend will start afterwards. So let's zoom out, move forward in the timeline a little bit and have a look. Well, yes, we can see that there is a good drop. We see a breakthrough, but we also see a new range being built. And this is what we like to see. Because if we're going to be trading this way, if we're going to be trading with trends and breakouts, well then what do we want to see? We want to see trends and breakouts, obviously, because that's what we're looking for. So when you're looking for something, you like to see it. It kind of makes sense. Retail traders are not always seeing these trends. Well, how do we know that retail traders aren't seeing these trends that well? What tells us that retail traders aren't? Well, Pierre makes a very good point. They lose money. Well, yes, that's definitely one way. They go against the market. We trade against them. We're making money off them. Yeah, but it's the panic buys and sells that we see in these massive jumps. All right, between these two ranges, we're seeing these massive jumps. And by massive jump, I mean in either direction. We just see mass movement. It's because the retail traders are panicking. They're either going short or they're going long in the wrong direction, going against it, trying to get out. And that's where they're losing their money, and that's where we're making our money, because we're spotting these trends that they're not spotting. Okay, we can see a big jump down, we see the big jump up, we see the new trends, but that's brilliant for us. That's what we like to see. Now, I'm bringing up a different one now. I'm bringing up Apple stock. All right. Now, one of the reasons we're looking at Apple stock is because we were talking earlier, some people like to think that the stock you trade has an effect. You know, oh, I only trade Apple because it's a little bit cooler. I only trade Facebook because, you know, I'm a social media guru. But what you'll notice here is, does anybody notice a big difference between this graph and the last few that we've looked at? Okay, yeah. Jade noticed that, yeah, it's gaps. There's all these holes. It kind of looks like somebody spilled Tipex on my chart and now there's gaps missing. There's little holes, right? Now, you'll notice that this is a daily, and because it's a stock where the stock market opens and closes, overnight something can happen. You know, Apple can announce that the new iPhone prints money or produces food, or they could, you know, another tech company could say that they've invented an iPhone that is a quarter of the price, which could affect Apple's stock overnight, which means that the next day you come in, right? So say you're going to, I have a housing estate agent, and I have all these beautiful houses, and where I'm selling the houses, and at the end of day one, all of my houses are going for 100,000. Now, I lock up the office. My closing price was 100,000 per house. I lock up my office and I go home, and you're considering buying a house, and your friend is considering buying a house. So you're saying, you know what, we're going to go to Sean's office tomorrow, we're going to buy a house, we're going to pay 100,000 each. These are beautiful houses, I've seen the ads for them. You go home, and in the 9 o'clock news, you see that all the houses I'm selling are actually on a waste dump. There is nuclear waste under the ground. Now, you still want these houses, but what are the chances you're going to pay me 100,000 when you come in the next morning? Are you still going to give me 100,000 per house? Yeah, probably not. So the market closed at 100,000. You came in the next morning. Now, I might have said I want to sell at 100,000, but all the buyers standing outside are not buying at 100,000. So I go down to 10,000, and that's where you start buying, and that's where the new price opens. And that's the gap overnight. So that's why you see these little gaps here, because the next day when the market has opened, some things might have changed. So just remember that this happens way more with stock, because things can change overnight. Companies make announcements. In Forex, which is why we've been looking at US dollar, and we're looking at a few others, they're more liquid. There won't be as many gaps because it doesn't stop trading. If you do see gaps, it will generally be over a weekend when the Forex does stop trading. Now, I have explained to you what gaps are, but I want you not to worry about them too much, because again, that's not what we're looking for. I want you to remember there are a lot of things we're going to hear about and people talk about. We don't care. We only focus on what's important. Only focus on what's important and affects our money making decision. So what are we looking for? Well, we're looking for a ceiling, and here we can see one. All right? We can see a ceiling up there to the top right. It's a pretty clear ceiling. Now, if I was to ask you, here the ceiling is at $421 per Apple share. Is that an expensive or inexpensive price for an Apple share at this point? And I just want you to type in EX for expensive or IN for inexpensive. Okay, some people saying expensive, some people saying inexpensive, and other people giving me the answer I'm kind of looking for, which is I don't care, or I don't know, let's see, or let's wait and see. Well, as you can see down here, the date range is the 27th of July to the 5th of January. So some people say it's expensive, some people say it's inexpensive. What happens if I zoom out? Well, if I zoom out and we look at the same price range, and we look at the 4-to-1 mark, and we see it rocketing up after that. Right? So it was cheap at the time. So all of the people who are saying it was cheap, fair enough, you got it right. But that was a guess. We weren't sure if it was cheap or not, right? So we know now that the price was fairly cheap. But so what's important to remember from that point is just because an area of the chart is high, that doesn't mean where it will stay. When we zoomed in, and now this chart again looks like, oh, well, at the right-hand side, it's up high. It's at the top of the chart. Well, I don't have any more paper, so surely it can't go up any higher. Well, unfortunately, that's not how stocks work. Just because an area of the chart is high, that doesn't mean it'll stay there. If something is going well, why wouldn't you want to jump on board? All right, so here's a more recent chart. We can see, again, we see our ceiling, we see our floor. We can see a once-off breakout that came back into the range within the day. Can everybody see that little green breakout at the bottom there? But it was only within a day. And we can also see a little breakout to the top right, but it came back within, 7 or 8 days? And also we can see a good gap there. Now remember, a gap isn't a big deal, it's just supply and demand. It has no effect on our decision. What are we looking for here? Are we looking for going long, or are we looking for going short? At the point of 19th of November, what are we waiting for? Are we looking for going long, or are we looking for going short? We're definitely getting there. I can see more weight than I have before. Some people still a little bit impatient. I love the enthusiasm. I love that you guys want to get out there. You want to trade. You want to put your money down. You want to get in there as soon as possible. But calm down. Rein it back a bit. We're still going to wait. Right? We're waiting for confirmation. We want to be sure. It's great to be enthusiastic and to be energetic and want to get out there and get involved. But if we're not sure, then why would we want to throw our money out there? Not yet. So, breaks and exits. obviously we've talked about getting into a trade. We also want to know when to get out of a trade, which is an exit. So obviously an exit is where you leave the trade. Now where you leave the trade defines the success. Because if you were buying and you sold at higher than you bought for, you're making money. If you were selling and you bought for lower than you sold for, then you're making money. So it defines success. So the problem with it being the thing that decides success is that it is the hardest part of trading. Now there will be losing trades. You have to remember that. If you knew exactly when to exit, if that was easy, then we wouldn't have one of the best trading company programs in the world, because people would just do it. But luckily, for us, it's a little bit difficult. It's something we can talk about. It's something that we can share with people. And that's what makes us, us as trader, I'm talking about you and me, that's what gives us the little bit of an edge. That's how we're going to do better. So you must decide upon a negative price which, if reached, signals your analysis was flawed and you have to exit with a loss. So sometimes we are going to take small losses, and we have to be aware that this is going to happen, but that's okay. That is just part of the process. It's a learning experience. Sometimes the break didn't go the way we thought it would go. But again, later we're going to explore financial risk, and we'll get into that in depth far more down the line. But right now, again, I just want you to focus on technical price-based exits. So again, don't get too hung up with the terminology and what we're going to be talking about as we go through it. Focus on the important points. Now, remember, old resistance is expected by many to act as new support. So, just human nature, again, psychological, whatever it is. If something breaks through a ceiling, if it breaks through resistance, a lot of people will expect that to be the new support. And the other way around happens as well. Old support will be expected to act as future resistance. So if the former support or resistance are re-breached after the initial break, this could signal an objective exit. So if the price returns to its range, the initial analysis for the breakout was flawed for whatever reason. Again, we don't care, as the market has failed to perform. So a return to the range could signal a stop and reverse type approach, which would be objectively justified, which is exactly what we're looking for. So again, let's have a look here. Again, we can quite clearly see a well-defined ceiling, easy to spot. We can see a rising floor. Now, I want you to look at the point 19th of November 2015. This is the Apple Daily stock. We can see the floor, we can see the ceiling. If I was to ask you, would you go long or would you go short? What would you tell me? Jennifer, you're in straight away. And we're all, yeah, exactly. Now, I hope you're all just not saying wait for confirmation, because that has been the answer so far. I hope you all understand why we want to wait for confirmation. Okay? It's because we don't have a confirmed breach yet, right? We're waiting for the confirmed breach before we get involved. So the same way we have, losing exits, well, of course, we're going to have our profitable exits. These are the ones we want more of. And, we're going to have more of, because you guys are training yourselves, you're teaching yourselves. This is what we're going for, so that's what we're going to get. So let us assume you entered on the break and the market did continue in your direction, as you predicted. What then? How do you manage the trade? We're now going to be talking about profitable exits, which involves in trends. So retracement is the answer. So if the market makes new highs or lows opposite to the direction of entry, we see confirmation of a reversal. So again, we're looking at the Apple example. We can see a clear ceiling. We can see our support or clear floor as it rises. So we're waiting for confirmation. So a good starting point for your stop loss would be when it starts to return to the range the breakout started from. Okay? Entry at the open outside would stop back within the range, right? So we have the range. So when it goes down here, when it goes through the break, that's where we enter. That's where we go short. So we're going short because it's broken through the support. It's going down. And our stop loss to get out of the trade would be back within the range. So it would be, roughly at the floor again, or the previous floor, which is what we would now be calling our new ceiling or our new resistance. Does that make sense to everyone? Can you see why you would do that? It's when it starts returning, obviously you want to get out of there because you wouldn't make any money if it did keep going back to, if you go short and it comes back above where you went short and then keeps going up, you're losing more money. So that's where we're putting in our stop loss. Now, we're going to be talking about this a lot more as we go through the course and a lot more as we get focused. I just want you to just process the ceiling and the floor, the support and the resistance and the breakouts. Don't focus too much on the stop losses getting involved. We're going to focus a lot more on that as we go ahead. So you can wait for a close on the far side of a moving average. This would be a natural sign of retracement, perhaps a 10-period moving average working from longer time periods. This is something we're going to be looking at way more in depth in lesson 8. So don't get hung up on this now. This is me just giving you a sneak preview, not something for you to understand. Okay? It's just this is what a moving average looks like. Just to give you a little bit of idea, it's a useful way for trading for retail traders as they get very objective entry points and give objective exit points as well. Again, don't want you getting hung up on that. A trend is just a directional channel, right? You've already looked at this. You already understand this. I'm just giving you the names now as we're wrapping up, right? Assuming we caught a breakout and traded in its favor, if the market continues, it's classified as a trend. We all know what the word trend means, and it's simply the same in trading as well. Just something that continues going in a certain direction, it's a trend. We can also remain in this market and exit on a break if it's trend line or if it's moving average as seen above. Again, nothing to get hung up on because we're going to be talking about moving averages a lot more in lesson 8. There may also be a confined diagonal channel which may signal a reversal. So let's have a quick look at trends. All right. So is this trending upwards or is it trending downwards? Okay. All right. Yeah, we would say in general upwards. We can see the ceiling, but we can also see the floor and it's moving upwards. Right? This one, again, are we looking at trending upwards or trending downwards? All right, again, yes, it's trending upwards here, and then we see a breakout going upwards. Now, just because a stock is trending upwards or downwards doesn't mean the breakout is going to happen upwards or downwards. So don't get too hung up on that. Don't getting attached to that. We're still going to be doing the same analysis that we're always doing. We're looking for a breakout from our trend. So where would you put an exit on this strategy? Just give me a rough idea. We can see even our breakout had an almost floor and ceiling. And then the new trend started with a floor and ceiling. So we can see a new range. So yeah. Well, it depends on where we got involved in the trade, okay? So it depends on if we decided to go long or if we decided to go short. So if we got involved on the 23rd of November and we decided to go long and it went well as it broke out upwards and we spotted that breakout, where would we have put our stop loss? And that's right, people are saying about 0.99, 0.97. That would have been a fine place to do it because it was a previous floor. We could have done it a little bit higher. It kind of depends. But what happened was we saw a new floor going up. We saw it. We could have drawn that green line and we could actually have put our stop loss at 1.02 as we got to the 30th of November because that's the way the floor was heading and we kept up with it. We kept updating our floor. Now again, don't get too hung up on it. This is something we're going to be going more in depth later. Just a preview. Again, all you're looking for is floors and patterns. Now this one's a little bit less obvious. We can see that the floor is rising, but we can see that the ceiling is dropping. So you can have smaller ranges and larger ranges. So in these areas, this is where retail traders lose and this is where we win because we still manage to spot the breakouts. All right, you can see the resistance and the support going in either direction within the range. And sometimes it's important to notice that you can have a range within a range. You can have a floor and a ceiling happening within a greater floor and ceiling. And what we see here is that this is where the retail traders lose because they're not spotting these breakouts, which when we look at it are actually quite obvious to us. Now they're a lot more obvious when we apply lines to them and draw green and red lines, but as you go on, you'll notice that you spot them as well very, very easily when you look at these charts. Now, this is one of our proprietary methods here. This is me just throwing even more information at you to try to confuse and scare the hell out of you. But don't worry. Remember, this is just, we're combining a few ideas here to find real opportunities going forward. And what I want you to remember is all this extra information right now, this will be very clear to you when we get to lesson 10. This is just showing you where we can have a moving floor, we can have a moving ceiling. We're going to be looking at lots of things. Now, we're coming to the end of the lesson, but what we're going to do is examine a quick chart. And I'm going to ask you, do you want to go long or go short at a certain point? So, what I'm going to do is, I'm going to point out the floor. I'm going to point out the ceiling. So, at the point 14.129, do you think it would be better to go long or to go short? All right, some short, some long. It wasn't a trick question. The right answer is wait for confirmation. We always want to wait for confirmation. All right, so tonight we were talking about support and resistance. We looked at breakouts, which is just when it goes outside of the support or the resistance. Remember, support and resistance are zones, not just straight lines. Trends, which is just the direction it's heading that we can see when we're looking at it. Channels, we looked at we looked at channels as well, and you know how many other traders approach the markets. What tools they use is what we looked at as well a little bit. So we looked at what retail traders are doing. So we want you to become a counter retail trader, because when they lose all their money is when we come in and we pick up that money. So obviously, as always, attend as many of the live sessions as you can, because it always helps. The next session is building your trading toolbox, which is obviously essential for finding opportunities. Right? Remember, recordings are uploaded within 24 hours of the completion of each live session. To access the recordings, you just go to academydeft.com, sign in the top right corner, and you'll get there. Now, guys, when I say we're building a toolbox, I want you to remember it doesn't all have to click with you straight away. You know, each lesson is a little bit separate, and you haven't had them all linked together yet. Talk about a strategy. You know, if a carpenter was on a very basic course, and I spent an hour explaining to him what a nail was, and then he comes back 2 days later, and I explain to him what a hammer is, and we're talking about it. He now knows what a hammer and a nail is, but I still need another class to show him 2 wooden boards and how to hammer the nail into the wooden boards with the hammer. So we're going to show you each tool one at a time, and then we're going to show you how to use them all together. And it's only when you have them all together, working together, that you see their true power. Right? So here at the Shaw Academy, as well as the Academy of Financial Trading, I'm sure many of you are aware that, you know, we're sister companies linked within one another. I think Tom went through it on the previous lesson. So obviously our full focus is on education, which is one of the reasons we're going to be giving away $30 million of education to causes throughout 2016. Obviously, we have brought in lots of key personnel dealing with government lessons. But one of the reasons we want now to say this is because we want to ask you for reviews. And when I say asking you for a review, it means good or bad. To us, a good review is an honest review. Because if you don't tell me what I'm doing wrong, I'm one of those Irish guys who's very cocky, very oblivious to my own mistakes. If you guys don't send me emails and say, Sean, you talk too much, your analogies are weird, you smell like cheese. If you don't send me something and explain it to me, how do I know how to fix it? If you tell me what I'm doing wrong, I can fix it. But if you also tell us what we're doing right, we can ensure that we keep doing that. So we're constantly looking to improve, and the best people to tell us how to improve are you guys. You know, you guys and women, you guys and girls, ladies and gentlemen, whatever way to say it, you've been with me now, with us, me and Tom, for 5 lessons. You're getting a bit of an idea of how this is done. So now is a good time for you to come tell us how you feel. You can go to the Shaw Academy Facebook page, or if you want to leave a review anywhere else, wherever suits you, but the ones on the Facebook page we see very easily, very quickly. You just go to Facebook, type in Shaw Academy, pops right up. Let us know what you think. Let us work on it. Let us try improve and get better so that you yourselves can get the benefit of us, but that future students get it as well. Right, so now that I've been waffling on for just over an hour, I must apologize for first going over that hour. I'm very sorry. I will try sharpen that up a little bit. That is one improvement I know I have to make. And secondly, I'm just going to take a quick drink of water, and then we're going to come back and do the Q&A. All right, so I'll talk to you all momentarily after I've had a quick drink of water, and we'll go through our questions. Okay, guys, so I'm back. Let's have a look at some of these questions. Okay. Azhar Aladad, when you look at charts, how do you decide what time frame to look at? Minutes, hours, or days? Azhar, that, different traders do different ones. But what we do is we only look at daily charts. And on average, we would look, our trade lasts about 10 days. So that's what we're going to be focusing. That's what we're going to be looking on. Obviously, we'll talk about the other ones as well, but that's our focus, and you'll see why as we go through it. What do you mean by a retail trader? So a retail trader is someone who kind of trades without a plan and loses. They're kind of non-institutional traders. You know, when you're talking about guys who like gut feeling up and down, like I like this stock, I don't like that stock. Not the best way to be trading. How many bounces off the ceilings and floors counts as confirmation? Interesting, Hassan. How I always say to people is, where do you see a pattern? If I was to say to you, the number 3, then the number 9, what comes next in that pattern? Well, some people would say 3, then 9. Well, obviously, Sean, the next number is 81. Because you've just been multiplying the number by itself. I said, well, it could be 81, but it could also be 15, because I could just be going up in increments of 6, 3, then 9, then 15. But if I tell you 3, 9, 15, what comes next? Well, then you know what way I'm going. So the next is 21. So I would say for a pattern, I would say at least 3. Sometimes 2 is enough to say, okay, you can see it because you can see it very obvious and it's staying there. But 2 to 3 is where we would look at, that's enough of a pattern to actually say, well, there's our floor, there's our ceiling. Okay, Mia, you send in a suggestion of new courses after the lesson, but I didn't get the slides. Mia, that means the slides were being collected and being sent out. I'm sorry if it hasn't gotten to you yet, but if you contact your trade support manager, he will get them to you even faster, because at the moment it's just the support team. Obviously there was huge response to that. Thank you all very much, by the way. It was fantastic response to hear from you all. But the support team is trying to get through them all, which takes a while. But if you get in touch with your support manager, they will get to you far faster. They'll handle, obviously because they're assigned to you, they're going to want to take a little bit more care of you. If you do it that way, it'll be with you much faster. Where do we find the candlestick charts? Michael, don't worry. Don't get ahead of yourself. Don't rush. We're going to be showing you all of that. We'll show you where to get them, how to build them, go through all of that. So don't worry. After we're done with all the live sessions, we'll have access to all time recordings for how long? Sarang, that is for up to 12 days after the last session. So lesson 10 comes out on a Wednesday, and then for 12 days you will be able to access all of the recordings to review them before taking your final exam. I think I missed the confirmation of the breakout. Will I see it on the on-demand later? Daniel, yes, of course. This recording will be up within 24 hours in your student area. So you can log in there. You can go back through it, double check anything that you might have not fully understood or that you thought I maybe went through too quickly. So have a look at the recording again. Go through it, take some notes. If you still need a little bit of a hand, get in contact with your program support manager. They would be very happy to go through it with you. All the lads inside love talking about this stuff. So, it's all we chat about all day. I saw quiz 1 on the Academy website. Can I take it now? Yeah. And when should we complete this by? Stephen, it doesn't count towards your final exam, so you don't have to have it done by any certain point. It's there for your practice, for you to get engaged with, for you to check your knowledge on the videos that it's been covering. So quiz 1 covers the first 3. So it's just to make sure you're there. Feel free to take it more than once. Take it as many times as you want just to get used to it. Another question about where do we get the candlesticks. We'll be showing you that, don't worry. I have a question on selling. Is it not? I'll sell literally, but I'm not sure how people make profit by selling. Can you please give me a quick example? Yeah, don't worry, Sanka Hill. It's not just you. Plenty of people get involved in it, right? So the way to remember selling is you're not actually selling anything, right? It's just the term for I'm predicting it's going down or going short or selling. But if you want an example that makes sense to you, is that you have 2 friends. John and Mary, okay? John has a car that is worth 10,000 that he wants to get rid of, and Mary wants that car. Now you know that that car is going to go down in value to 2,000 euros. So what you do is you walk up to Mary and you say, "Hi Mary, I'm going to sell you that car for 10,000 euros. And Mary goes, "Lovely, thank you very much. Thank you for getting me the car I want." And you say, "Brilliant," because you know the value is going down. So you tell Mary, "I'll bring it to you in a few days." Then you wait a few days and the value has gone down to 2,000. You go up to John, you say, "John, that car you have is only worth 2,000. Give it to me. I'll give you 2,000. John goes, "Yeah, no problem." So I get the car, I give it to Mary, I get my 10,000 euros. I only paid 2,000 for it, but because I decided to sell at 10,000, I've made 8,000 euros. Now, hopefully that example makes it a little bit easier for you to understand. If that example still doesn't make it easier for you to understand, we'll get in touch with your program support manager. They'll go through it with you. We'll have a bit of a chat. But it's not something you need to get too hung up on. Just remember that when you sell, you think it's going down. You're going short. You think it's going down. And when you buy, you think it's going up. You're going high. I am unclear on the minimum time range required to get a confirmation. Paul, it's not so much based on time. You know, it's vastly different time frames depending. It can be a couple of days, it can be a couple of months, but you know what will happen is as we go through it and we work on these charts and we show them to you more and more, as you get more and more used to them, you'll just start seeing them without having to think about the time scale too much. And that's just something that will come through practice and training, and we're going to take care of the training with you. We're going to go through it, so don't worry, that's not something you need to be getting stuck on right now, okay? In some area, we saw the trend breach the ceiling, but it came back all down to floor again. How can we know the breach is genuine and the trend will go up? Omid, yeah, that's what we were calling false and genuine breakouts. Now, they will happen, and sometimes you will buy into a false breakout and you won't make any money off it, okay? So it will happen. You will have these little ones, but you're not going to lose a huge amount of money either. So it's okay to get involved in these little ones. But what's important is that when the big ones happen, that's when you make big profits. So you will see the little breach, and what you're trying to do is, that's why you have a zone. That's why your ceiling will have a no-fly zone and your floor will have a no-fly zone, your resistance and your support zone, so that you can account a little bit for the false breakouts, but you will still have ones that will go fully outside and you'll think it's a breakout, but then it comes straight back in. So they will happen. They will, you know, you have to expect them, but as we go later in the course, again, we're going to be talking a lot about how to handle these and, you know, how to account for them. Let me see what else I can see. We don't have to do the quiz by any time. Brahim, no, not by any time. Can we download the videos for our future reference? Manoj, unfortunately not, due to copyright reasons. They're not downloadable, but you can review them in your student area. So work away just looking at them as many times as you want. Let me just see what else I can see. When will the final quiz be made available? The final quiz will be made available just after lesson 10. But don't be worrying about the final quiz yet. We're only on lesson 5, so don't worry. Is this binary trading? Wayne, no, we don't recommend binary options trading, as it's, you know, kind of like, it's basically gambling with no trading edge or strategy to it. So, like I said, our focus here is not to be cool, it's not to be in Wall Street, it's to make money. Now, if your focus is to be cool and you don't care about profits, then maybe that's something you can do. But I'm pretty sure you want to make money, you want to have a strategy, you want to have a trading edge. So that's why we do it slightly different. How do you work out the gradient of the floor or ceiling? Is it an educated guess or software? Ian, it's a very, very educated guess. As we'll talk about it a little bit, you can get software to help you, and they will spot it, and they'll map it out, and they'll build them for you. But as we go through it, as you see more and more of it, you'll see that it is a very educated guess, and it can be refined very well, and you can do very well with it. How many trades are you making per day? Ross, that is a very personal question. If we ever chat on the phone, I'll go through it with you then, but it depends. It really varies. It depends. If I see lots of opportunities, I'm making lots of trades. If I see no opportunities, I'm making no trades. It's all about the strategy. I'm not making trades just for the sake of making them. How do we access the careers advancement program? Okay, so I don't know if Tom mentioned on lesson 2 or 3, or if I mentioned on lesson 2 or 3, but we do have the SATS, the Shaw Academy training, what was it, careers program? I can't remember what it was called, sorry. It was SATS. Shaw Academy Training Support, that's it. And it's to help people with their careers and stuff. That will be available. We'll talk about that later. Don't worry, it'll be available to any full-time members of the Shaw Academy, but that's something we can talk about down the line, so don't get too hooked up on that now. All right, guys, it's gone past 20 past, so unfortunately I do have to let the guys go. We've go home to their families, etc. I would like to thank you all very much for your attention all the way through this lesson. Fantastic interaction again. I hope it was all clear to you. If I didn't get to your question live on air, I'm very sorry. But what I would say is either email us at support@academyft.com, or if you've already spoken with your program support manager, get in touch with him either through email or phone, and he'll have a chat with you. Or you can expect a call from him in the next few days as they get around to chatting with everyone anyway. But if you want to ask a question, just email us, support@academyft.com, and we'll be sure to get back to you. All right. Thank you all very much. Take care now. Bye-bye.